Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. Sitting across from me, we have David Llewellyn-Smith, co-author of The Great Crash of 2008 with Ross Garnaut, also the founder of internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business financial blog. We also have Leith Van Onselen, our resident Nucleus Wealth economist, who has spent time with both the federal and Victorian treasuries, along with some time as an analyst with Goldman Sachs. Leith now co-authors the widely read Macro Business financial blog with David Llewellyn-Smith. And finally, we have Nucleus Wealth's head of investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, of course, please check out our people section at www.nucleuswealth.com. Yes, so hello and welcome to yet another instalment of Nucleus Insights, and today we thought, just given the recent revelations in the ongoing Royal Commission into the major financial institutions, we'd do a little bit of an overview into the big four pillars of our financial landscape in Australia. Our thoughts, I guess, in regards to some of the, the history and the projections on where we think it's going forward, and then, of course, overlaying that into investment decisions and how that affects everything we do every day at Nucleus Wealth. As an agenda, I might just add, we've got a full house today once again with David, Leith and Damien, and we have got this is going to be a pretty deep dive, so into the big four pillars of the banks, so to speak. So just hang on to your hats. We are actually going to be, it's quite chart heavy, and I might use this point to also just let people know that we've started our podcasting, which is available through iTunes. And so if you are checking that out, feel free to hit us up for a chart pack as well, just to go along with that. So onto our agenda. So we're looking into obviously an overview with Leith, with the an overview of the banks, a little bit of historical information, and then parlaying that into referencing that into the Australian economy. We'll be bringing into questions some of the lending standards that have come out of the recent Royal Commission, and so David's going to be firing off some charts in that direction. We're going to be looking at funding costs, where the banks are getting their money from, and will that continue? And once again, a little deep dive into some of the key takeaways from the Royal Commission, how that will parlay into government policies. And then we'll finish that up, as always, with some investment fundamentals on the banks vis-a-vis themselves and also against world banks. And finally, some conclusions. So a pretty big topic on a pretty big part of the Australian economy. So without any further ado, we'll dive into it. So Leith, welcome. And what have you got for us? Assets to GDP.
Yeah, g'day, Tim. Hello, everybody. Look, you don't have to be a rocket scientist to know that the Australian banks play a major part in the Australian economy. And we've got a chart here, and it basically tracks the Australian bank's assets relative to Australia's GDP. And this is sitting at around 2 times Australian GDP currently, after growing massively over the past several decades. And to a large extent, the Australian banks assets are due to obviously mortgage lending, which comprises most of their lending and most of their assets. And this has been driven to a large extent by the bank's heavy borrowing from offshore. The Australian banks have borrowed nearly $900 billion of funds from offshore, which has helped obviously fund their mortgage book. And that represents around 50% of Australia's GDP. So the Australian banks play obviously a massive role in the Australian economy, a massive role in fueling the housing market, and pose obviously a major systemic risk, which is why they're often considered too big to fail.
Sure thing. Okay. And in regards to into credit, there we've got an interesting graph of, I guess, the fall away of business, private sector credit, and in return a rise in housing.
Yeah, that's right. Like back in the early 90s, about 2/3 of the bank's lending was to productive businesses. However, now that's fallen to below 30%, and at the same time, lending for mortgages has risen from about 1/4 of total lending to 62% of lending, which is currently an all-time high. So the banks have been more concentrated than ever in mortgage lending, which again comprises most of their assets.
Okay, lovely. And of course, then this naturally just moves into as often touted on the blog and easily found elsewhere as well, a continual rise in Australia's household debt.
Yeah, that's right. Well, obviously, more credit means higher household debt and also means higher house prices. So Australia's housing market, as we all know, is one of the most expensive in the world. But Australia also has the second highest household debt levels in the world, which is fueled by mortgage lending. And we've simply got a chart here showing that Australia's household debt to income is currently 190%, which is at all-time highs. And according to the Bank for International Settlements, again, Australia's got the second highest household debt to GDP. Just behind Switzerland. And as a result, obviously Australia's housing market is amongst the most expensive in the world, with valuations never seen before at these levels.
And it's worth commenting as well, if you look at the Aussie banks versus the international banks, so if you're sort of an international investor and you're deciding which bank you'd like to invest in around the world, that's reflected in the Aussie banks as well. They've got much higher exposure to household mortgages than comparable banks overseas.
Okay, thanks, Damien. Sure thing. On that note, obviously, when you're using words like all-time high in debts, it's always going to create a fairly precarious position for investing in the short to medium term, and that brings us on to, of course, lending standards. So I'll peel over perhaps to David. Oh no, we're going to keep going with Leith. Sorry, so Leith, keep going.
Yeah, look, for many years, the government, the banks, obviously apologists for Australia's expensive housing have said that Australia's had, safe and secure banks. We've got some of the strongest lending standards in the world, et cetera, et cetera. We've all heard the arguments. Some of us on the other took the other side of the argument, arguing that Australia's banks weren't actually that safe and they were taking a lot of risks with their lending and credit exposures. And this has actually come to light with the Royal Commission that's been going on the past few months, which has revealed some, quite frankly, shocking discoveries about the dodgy lending practices of the banks. And in fact, today, that's Thursday, the 26th of April, UBS has released an absolutely damning report on Westpac's mortgage book. And Westpac's mortgage book's about $400 billion. So that's about 1/4 of Australia's total mortgage lending. And what the UBS has discovered from data which has been released as part of the Royal Commission is that in a sample of 420 random Westpac mortgages, they found that 80% of Westpac's mortgage controls were ineffective. This data has also found that minimum income verifications were not completed for nearly 1/3 of mortgages, so 29% of mortgages. 86% of this 420 sample of mortgages had assessed their living expenses as equal to the household expenditure measured benchmark, which is considered a minimum. So nearly all of them were considered the very bare minimum required by the laws. 2/3 of the mortgages assessed, the sample had no itemised living expenses, and the list just goes on. And in fact, they also found that nearly 1 in 10 mortgages would not have been approved if the information was truly stated. So basically, liar loans are endemic. With Westpac's mortgage book, and UBS thinks that it's probably repeated across all the majors. So they have a severe problem with liar loans. UBS also found that the median debt to income of Westpac's mortgage book is 5.4, which is considered very high, with just over a third of those mortgages assessed at with median debt to income levels above 7 times. And so we've got a huge problem here. This is obviously just one of the 4 major banks, but UBS believes that this is probably prevalent across the other major banks as well. So this whole notion that Australia's got safe and secure banks, we've got quality lending standards, etc., has been completely blown out of the water by the Royal Commission. And every day it seems we're finding out new scandals, and we'll get onto some of the implications of that later on when we all chime in.
Okay, thanks for that. Yeah, Leith, those are some pretty remarkable figures. I think anyone would agree. And as you say, if we can just transfer, similar levels, and at the same time, the banks they all sort of they're quite symbiotic in the way that they apportion risk. You'd think at a top level that it's a bit of a worrying sign going forward for pretty much any of them, really.
Yeah, one thing I did forget to mention was that the financial position was apparently misrepresented in 30% of the sample, and also I'll just add another one. I missed as well. The minimum assessed household expenses were just 23% of household income, which is considered ridiculously low. So again, liar loans seem to be very prevalent across Westpac's $400 billion mortgage book, which again is 1/4 of Australia's total mortgage book.
This is starting to look like the Royal Commission we had to have, I think, somehow. But anyway, okay, sure thing. So yeah, thanks for that, Leith, and a great introduction to I think a pretty prevalent theme throughout our presentation today. So I'll jump over to David Llewellyn-Smith. So hi, David.
Hi, Tim.
And we'll be looking into the lending standards and all things dodgy. And if you'd like, we'll kick it off with expenses.
No, actually, just fast forward a bit.
Okay. Where would you like to begin?
Sorry, Leith's more or less covered that. Those charts were all from the UBS report, so...
Happy with that, okay.
Listeners can take a look at those at their leisure.
Sure.
Just the one thing to add on the end of the lending standards issue is the interest-only reset that we've got underway, owing to the interest-only lending boom that transpired after the mining boom went bust. And is now moving into a phase where interest-only loans 5 years on are resetting to P&I, or principal and interest. And that's another lending standards issue, the legacy issue, if you like, where because APRA, the regulator, put a cap on the number of those loans that could be issued as part of the mortgage book a year or two ago, suddenly there's all this big refinancing need, but the banks have got interest-only percentages of their book capped. And so there's now a debate underway about how much in the front book and the back book of the banks can absorb this reset. Because a lot of people obviously have borrowed not only in terms of liar loans, but assumed that they could roll over these interest-only loans endlessly.
Absolutely.
And they can't. And so I've got a chart there that's my guesstimate of what this will mean, where I've basically drawn up what is an abnormal reset above what 30% of the mortgage book would be if they can't find another way of sort of managing these loans. So it's of comparable size, if my guesses are right. It's roughly the same size of reset that the US saw during the subprime debacle, where you have it's somewhere between sort of 3 and 6% of the mortgage book will struggle to be refinanced. And the US, of course, had a similar experience with subprime resets and ninja loans and various sort of things that were similar to interest only.
Yep.
Though, a bit different and named different things, but similar experience. So that's the sort of last of the lending standards issues that form what is obviously a very difficult, questionable base for the bank's balance sheets. Damien, did you want to add something?
Anything to add there, Damien?
Yeah, I guess I was going to point out some of the, as you said, there were some differences in the US, but it's the message. The numbers might not sound that big when you're talking a couple of percent of people making a difference, but in terms of the housing market, it really is that marginal person that can afford to buy a house that drives those prices. So it's a very inelastic supply and demand. But if you can get that part where you can bundle a few more percent of people in, whether it's through first home buy grants or lax lending standards or things like that, you get a decent push up to housing prices. But the reverse is also true, that when things turn, you can see them quickly fall away, and it doesn't require a huge percent.
Okay, sure.
That actually was the mistake that the RBA made yesterday, or rather Tuesday, when they had a look at this issue, either a mistake or deliberate obfuscation, I can't say which, but they were averaging out the interest-only reset as percentages of income across the entire consumer market, basically. So
Okay.
they were hiding the fact that, it only takes a couple of percent of extreme discomfort in borrowers to pull down prices, and that's how you trigger wider distress in the economy. So the RBA either on purpose or mistakenly doesn't understand what this means if these numbers are roughly right. So moving on.
Sure.
So we've gone through obviously what we see is some very serious issues around lending standards. And the banks are getting caught in sort of multiple pincers at the moment. And the lending standards may or may not be tipping into this next category, which is they're also facing rising funding costs. That could be the first category there, with short-term funding, which is called BBSW for short, which is a bank bill swap rate. That's basically doubled the rate, and if you move to the next chart, you can see it in recent times. Now, this has been a global phenomenon attached to a jump in LIBOR, which is a London-based interbank rate that's very important for banks around the world, but it's been much worse in Australia than it has elsewhere. So there's an open debate at the moment about how much of this questionable lending standards is actually is causing the short-term funding spike for the Australian banks here, or at least making the international one worse here than elsewhere.
Okay.
So moving on to the next chart, the good news is that short-term funding spike has not really hit long-term funding costs as yet. It is up off its lows, and it may be that we've seen a bottom. We probably have, as global interest rates rise as well. But so far, the long-term funding, which constitutes a very large portion of the bank's wholesale debt, is still relatively cheap.
Okay.
It's worth
Damien?
highlighting that David's showing a chart of what's called CDS, which is basically the cost to insure against the debt going defaulting, showing it's a default on the debt. So when you put the four Aussie banks in relation to the rest of the world, you don't see a lot of difference between the big four Aussie and the rest of the world in terms of when you're doing sort of global comparisons. If you step outside the big four, though, you do start to see some big differences in terms of the costs that it costs to insure the debt. So for places like, say, Bank of Queensland or Bendigo Bank. And part of this comes back to the question with these charts is, is it hidden a little bit in that the Big Four have an implicit guarantee behind the debt, and so this is talking about a 5-year credit default. So it's basically saying, well, if I'm going to lend to the banks over the course of 5 years, and if I was worried about them going broke, I might charge a much higher amount. But if I think the federal government's going to backstop the banks if anything goes wrong, then I can obviously charge a lot lower amount because I think I've got a double layer of insurance there.
Sure. Okay. Yeah, very good.
Yeah, and we've seen that already in some of the mid-tier banks have already been forced to hike interest rates. ME Bank and BOQ has talked about it as well, because their funding costs are rising.
Yep.
More than the majors.
Okay, sure.
So that's another problem for earnings, basically, obviously, over the stretch. Particularly at the moment, we're talking about the short-term funding jump, and that basically is equivalent to roughly 3 or 4% of earnings that increase funding costs. So when we get to the valuations later on, you'll see that that's actually more than the entire projected EPS growth for 3 of the major banks.
Wow.
So it's quite a serious issue for earnings as well. So we've gone through dodgy lending standards and now rising funding costs. So we thought we'd also then move into the Royal Commission itself and look at what the likely kind of fallout of that is. The obvious one, and we've already seen this transpiring, is a further tightening of lending standards. And with stuff like UBS on Westpac today, it's a near certainty that we're going to see more of that. Westpac's been the first out of the gates in terms of doing this already.
Yep.
They've started to go for a lot more granular data on expenses and what have you, but they're probably going to have to do more. So again, you've got rising funding costs on one hand, which may be forcing them to put up interest rates, but they're also going to have to raise lending standards into their...
And you got the fixed, the interest-only cliff.
They've got the interest-only cliff, and then the dodgy lending standards as well. So you can see where this is all kind of coming to bear on both the balance sheet, the quality of the assets, and their earnings. All of these different pressures, and that's before we get to sort of the legal fallout of the Royal Commission, which is going to, it's unknowable at this point how extreme it's going to be for the banks. I think the key point on this is that, and probably why the government was so resistant to the Royal Commission in the first place, is the Royal Commission is outside the loop of the Australian government regulators and banking Ponzi.
Sure. Okay.
Right? So, we've known for many years that a lot of this dodgy stuff was going on because we saw many of the victims of it.
Mm-hmm.
And we know the regulator knew as well because it was allowing many of the victims to get paid out
Yep.
by the banks with hush money. We knew, they knew. So for the Royal Commission to come along and with the force of law and be operating on exposing this stuff, outside of the loop of captured regulators and government, where you have them all working together to just keep this Ponzi going, is potentially a game changer. And we simply don't know where the Royal Commission could land. Like, for instance, what Leith said on Westpac's expenses, where it was using the household expenditure survey for, what was it, half the loans? Or was
No, it's about 90%.
90% of the loans. Now, the Royal Commission might simply declare that illegal.
Okay.
And so the basis upon which Westpac has based everybody's expenses for their mortgages with...
On the minimum requirement.
The minimum requirement. There are, again, cost issues for the banks in this if they have to start actually doing banking. Then they'll need bankers that can do it. So the costs go up. Nobody in the banks knows how to do it anymore.
Yep.
So they're going to have to train everybody. But more to the point, it might just rip away the basis upon which some of these poor lending standards have been operating, and so the tightening in standards may be quite a lot of tightening.
Yep. Okay.
And cause quite a bit of distress in the housing market. And so we don't know where the Royal Commission will land on that. That's just one example, and there might be others. Then there's non-recourse lending is another possibility where if it turns out that what the banks have been doing was illegal, and the RBA's already declared some of this stuff illegal, ASIC's already in court over a number of these lending standards and violation of them.
Sure.
If the housing market really does start to fall, then class actions and jingle mail become a realistic possibility, because it's what you'll have here is systemic predatory lending. And so non-recourse lending, which is often cited as one of the key supports for high house prices, will simply evaporate. and so you see potential for much sharper downside in house prices.
Okay, Damien.
And just to elaborate on that, what David's talking about there is he's saying one of the things that's often held up for the US versus Australia is in the US, if you fell behind on your mortgage and your house was underwater, you could they call it jingle mail. You put your keys in the letter and you send it back to the bank and you say, "Here's your house back."
Yep.
Because in Australia the difference is you're on the hook for the debt. So if you're down $100,000 on the house, you got to pay your
got to find it somewhere.
You got to find it somewhere.
Yep.
And so what David's saying is, if you can turn around and say, well, yeah, but I gave my expenses and they then used a lower number and they lent me way more than what I could afford.
Yep.
And that's the reason why I fell behind. Not the fact that I did everything I could. It's just the bank lent me too much money. That's that's where David's coming from. And again, it's not, it doesn't require everyone in Australia to do that. You just need a substantial portion of people who fall under the spell of some litigation lawyers and bundle up together and go, well, I'm behind. I'm not going to pay my mortgage on this, and here it is back. And for the people involved, it'll be worth hundreds of thousands of dollars. If you've geared up enough properties and
absolutely,
that's so. It's not saying it's the right thing to do or the just thing or the moral thing, and not saying everyone's going to do it, but you just need a chunk of people to do. The less.
Well, it makes sense that when and this is the whole thing with the nature of the way the property market's gone, everyone's sort of had this. Well, quite a lot of people. Well, many people have had this. Unfailing sort of belief in the constant rise. So when your back is against the wall and everything's tumbling down around you, you're going to try and find a scapegoat, aren't you? And the banks are going to look like the primary targets.
Yeah, there's also another dimension too. That first chart showed that the banks are borrowed about $860 billion offshore, so they're highly reliant on offshore borrowing. And now that the maskers have been pulled off Australia's so-called prudent lending practices, there's a good chance that foreign lenders now to the banks will now demand a higher risk premium and higher interest rates to lend to the banks, because they now don't perceive them as being as risk-free as they were before. So that could also cascade into higher funding costs for the banks, which of course will then be passed on to mortgages and create a bit more of a shock for borrowers and also restrict credit even more.
Okay. Yeah, sure. Yeah. Absolutely.
And putting in context, our position, like during the financial crisis or a bit before as the financial crisis was happening and all this offshore funding just evaporated for Australian banks and was a massive issue. It's less of an issue now because the funding is a lot more domestic, but there still is a significant portion of the debt overseas. And so it hasn't got worse for the last couple of years, but there is still a significant amount of money that is funded offshore. And
it's safe to say that with the Royal Commission running, giving some global coverage of the behaviour of the banks, it's probably not going to wash well into the ability for people to give them more money going forward.
Well, that's where when we were referring to BBSW previously, the short-term funding market, where it's already spiked, the funding costs have spiked, and the debate is how much of that is local and how much of that is global. We just don't know yet, but it's quite possible, indeed likely, that some of it is simply fallout from the Royal Commission.
Okay. Yep.
It certainly would make sense. So there's also another potential fallout from the Royal Commission, and this one's a near certainty, where they're going to lose their wealth operations, either formally or simply doing it themselves voluntarily, and that might actually lift their returns on equity, but at the same time, that's going to trigger other waves of litigation where there are already huge group class actions underway from dodgy advice. So more costs, more payouts, more suing, more et cetera, et cetera. And
we were talking about it before, but there's that risk that as banks do unwind their wealth arms, that they may still contract a cold when larger problems, appear in these books down the track, and they're going to have to absorb. We're going to have to basically, essentially, take ownership for those, I'd imagine, if they want to retain any form of ability to have a financial service license going forward, perhaps. So, very good. Just one last one from Leith. It looks like.
Yeah, look, this is obviously separate to the Royal Commission, but Labor looks like they're very likely to win the next election, and of course they've committed to also bringing in curbs to negative gearing and capital gains tax should they be elected. So that'll just act as another stiff headwind for the Australian property market and also for Australia's banks.
Okay, thanks, Leith, and a great segue into our next topic in the agenda, which is, of course, government policy. So we've got, obviously, as you mentioned before there, David, the Royal Commission looking as a slightly external view to the regulatory bodies as they sit inside the purple circle that, funnily enough, contains the banks as well.
Yeah,
it appears.
Well, we've touched on that already, and we simply don't know where the Royal Commission will land, but it's almost certain that the regulators will try and water down whatever it is that they do or demand. Because even today, APRA has pulled back its first round of macroprudential. It's probably fair enough that it did, though the timing of doing so, I would have thought, is a bit questionable, given the Royal Commission. It's not a great look to be kind of loosening lending standards. But that brings us to the future of macroprudential, and I think probably the key takeaway from all of these kind of moving variables, we still have macroprudential 2.0 in place, which was the restrictions on interest-only lending,
sure,
which is what has in part created this cliff for the reset. One of the temptations that APRA will face is to kick that can if it starts to get quite nasty, and they'll, by lifting their cap and allowing the banks to run wild with interest only again.
Mm-hmm.
I think it's fair to say that given the Royal Commission focus now and into the future, because whatever implications that come out of it legally, the focus on lending standards isn't going to go away, so it'll be much more difficult for APRA to kick that can. Is the point, I think. Even if it gets difficult with the reset transpiring, it's an environment where making that kind of play as a regulator will be very cynical. Not impossible, but I'm just saying it's going to make it a bit more difficult. And then we go in terms of policy, as Leith mentioned, the forthcoming election, and there's probably 2 points to make on that. The first is negative gearing if Labor's going to get up. Obviously, it's leading in the polls at the moment, pretty consistently, very consistently, so it appears to be the favourite. The one kind of sticky wicket that it may face is if some of these pressures that we're describing start to come to bear before the election, so say in the second half of the year, if house prices were to sort of tip over a little more steeply, then a lot of its reform agenda is going to get pretty scary for the general population. And so, what is a highly admirable and excellent negative gearing reform platform could be turned into a terrifying demon by the coalition pre-election, and that might ruin Labor's...
Pull a bit of a wind out of the sails, you think?
Yeah, well, it's a nicely polished policy, but... it might be mugged by timing.
Too little, too late, perhaps, or
yeah.
just at least too late.
But one thing you can be absolutely certain of, I think, and this sort of just goes into intensifying all these pressures, is that the Royal Commission obviously has a massive albatross hanging around the government's neck. Like, they just were completely hoodwinked by this. They got the politics all wrong. They tried to stop it. For years, they contorted themselves trying to get it. They look like they're in bed with the banks. In fact, they didn't even call it until the banks said call it.
Wow, yep.
And so, more Royal Commission, the worse for the government. Converse for Labor, the more the better, because they obviously pursued it. They look like they know what they're doing. Their judgment is sound. And so, as we get the results of the Royal Commission, sort of both legal and in policy terms, Labor is going to beat that up as much as possible right into the election. So it's going to intensify all of these impacts.
Yep. Okay. Yep. That sounds fair.
And the other political side of it is, even if you do get a coalition return, chances are there's going to be a bit of a bidding war going on coming into the election about who can punish the banks the most, and it's sort of they'll need to be. There'll be a lot of one-upmanship about, we're going to do this to the banks, and no, we're going to do that, and that'll be going on. And so likely position is relative to where they are today, there's going to be a lot more regulation on a whole bunch of areas, and having an election sort of shortly after the final release of the final release is going to be it's going to be key to that. The timing. The timing is going to be bad in terms of given if you've got a fragile system and throwing more regulation at a critical point, it could be enough to tip it over.
Certainly doesn't sound like it's helping, and it is actually not a bad segue into your piece now, Damien, or you're led by you anyway, in terms of looking at the investment fundamentals. Obviously, the last sort of half hour or so has presented a fairly bleak set of prospects for Australian banks going forward, and so I thought obviously now is a great time to have a look at some of the historical key indicators and fundamentals that we look at for banks in investment, and have a look at where they might be going in the future.
Yeah, sure. Look, so I've thrown a chart together just on valuations for those who can't see it. We're basically just looking at the price to earnings ratios, the forward earnings for the banks, and where they've traded versus the Australian market over sort of 20 odd years. And they're cheap on these measures. So you're sort of sitting probably 10% cheaper than they usually were, depending upon which bank you're talking about.
Sure.
And if you gross up for the dividend, so you're sort of getting close to 7% yields on a lot of the banks, and you gross up for a dividend, and you're looking at about a 10% yield. So if you have a view that nothing bad this is going to be it's going to be managed gradually. There'll be a slowdown, and there'll be a bunch more regulations put on, but the housing market will sort of drift lower or drift sideways, and everything will be fine. The bank's probably not a bad, they're not going to be a great investment over that time, but if you can pick up a close to a 10% yield, including your franking credits,
Yep.
and the share prices fall by say 10% over 5 years, so you're losing 2% per annum on your shares and picking up 10% on your dividends, then in these low return world, an 8% per annum for 5 years sounds pretty good.
Yep, I agree. However,
yeah. So then you've got to look through at the earnings side of it, and I've got just a chart of the bank's earnings per share over a long period of time as well, and you can see the very impressive growth, particularly by the CBA,
which is the yellow one
the
for
yellow
those
line.
following at home.
Yeah, they've sort of dramatically increased their earnings over that time period. The National Australia Bank's been an outlier in terms of basically not going very far at all in terms of their earnings. A lot of that's been stuff ups overseas, and they obviously they had some UK banking, and they caught that in the financial crisis, whereas a lot of the Australian banks sort of got away relatively easily in the financial crisis. They're now basically domestic focused. They've got rid of almost all their international earnings, so sort of bit of a different bank. But one of the key things I want to draw attention to is the last, say, 3 or 4 years, earnings have flatlined. So you haven't seen earnings go anywhere for a decent period of time, and that's coming into this a number of earnings headwinds going forward. So I think in terms of earnings growth, we've seen 20 years of fantastic growth from the banks in terms of earnings and dividends. I think certainly over the next few years, over the last few years, that's paused, and I think a continual pause for the next few years is probably the best outcome, and some downsides quite likely in terms of that.
And obviously that's been off the back of obviously you're talking in growth being growth flatlining, but the banks have had the lion's share of the big announcements in terms of profits, as regularly in the tens of billions of dollars, and obviously there's been a surge in lending as well. So how are they doing more and making the same? Have you got some thoughts on where that or how that can eventuate? Has it been a couple of things? Perhaps the rising cost in their costs, lending costs,
yeah,
in the background?
changing within the banks. I mean, I think there's certainly a lot of it comes back to the charts you saw Leith put up before, which is the growth in household debt. So banks, one of the key drivers for banks is the amount of lending that's happening in the economy. If you're growing at 10 to 15% per annum increases in the loan books,
sure,
that flows through to your bottom line. You just keep more and more loans, and more volume, basically. If you've got your volume and your price side, the price has been, so that the margins the banks have been earning have been relatively stable for the last few years, so it hasn't been too bad on that side, and so it's just been the volume game.
Okay.
And the question then is, when you hit, there's a certain stage economies you need to look at it, we go, the households just can't handle any more debt, and I think we're at that point, and the question is, does it reverse, or can you? Is there another way? If you maybe some first home buyer grants if things start to go wrong, and some other, we can let some more leverage loose in other ways to try and bring forward this demand. But we're certainly reaching towards the end of the end of that debt game.
Yep.
In terms of how much more debt you can put into the Australian economy, which then just limits the banks. And the banks are so much of that lending that there's no not much room left for market share growth as well.
Okay.
That they also benefit from, because a lot of the smaller players during the financial crisis suffered, and so the banks picked up market share for the last 10 years or so.
And then just sort of carried it, essentially. All right, very good. We've got actually, before we dive into the international fundamentals there, Damien, I might just quickly throw to a couple of questions, just while we're looking locally on shore. I've got one here from Nathan. Given the precarious position of the big four banks and recent legislation protecting depositors, but not explicitly protecting deposits, he'd like to hear on our thoughts on the probability of a bank bail-in. We can take that on notice, or we can answer it now.
No. Look, I'm happy to answer that one. Look, I think but might throw to David as well as his thoughts, because I think in the end this is a political issue, more so than a financial issue. I think the banks have certainly had some implicit and even some explicit backing from the government during the financial crisis. I think there is a broad expectation that the banks that the big four, that the Australian government stands behind it. I think if you were a prime minister from any party and you decided that a bank went bankrupt and you would like the depositors of that bank to take a hit,
To cough up.
cough up, I think you're condemning your political party to 50 years of you wait for the next generation before
Or probably another generation again.
Yeah, that's right. Before you back in power. So a lot of it comes back to that. Does the Australian government have the capacity to bankroll these ones? Absolutely. We can print our own currency.
Yep.
Debt levels compared to other ones aren't too bad. I mean, we saw that happen in Ireland. Effectively, the government bailed out their banks, and that was even they had less of an incentive to do it because most of the money was German banks and other ones. So a lot of that was to sort of save banks in different countries that they sort of ended up backing their banks. So I think for Australia it's obviously a risk for people, but if things went pear-shaped, but I think there's politically it would be very, very tough.
Yep, sure. David?
I agree with Damo on that. I'd just add that my theory for how this would play all along is that the lenders, mortgage insurers, which insure the lowest quality mortgages on the bank's books, would wear so much of the pain that they'd be out of business in a matter of months and would be nationalised, and you'd see a kind of backdoor bailout of the banks, very similar to what happened on Wall Street with with American Insurance Group, AIG, and they just pay out these insurance premiums. They were originally these LMIs were originally publicly owned anyway, so it would just be a kind of round trip. The sticky question now coming out of the Royal Commission is if the banks are liable for some of these dodgy loans because they've failed to assess the criteria properly, and then will the insurers pay, and that would then open up questions around who else would pay or whether there need to be a more direct bailout.
Okay.
But it is also worth noting, David, that there's so little backing in these mortgage insurers that if you any decent downturn, they're toast anyway.
They just evaporate.
So it sort of ended up being, well, even if you go, we're worried that 25% of your things that went under might have been liar loans and all that type of stuff, is like, well, who cares? The other 75 are going to extend you broke.
That's probably right, because I think the last time I looked on Genworth, it was $2 billion in capital securing $371 billion in mortgages.
That sounds feasible.
Yeah, so obviously you can wipe them out very quickly. So that's probably where the hammer will fall.
Yep. Okay. Lovely. All right. So there you go. You need to just pop down to your local member to get the answer to that question. Thank you. Thanks, Nathan. One other one, actually, just before we move on with Damien's section, was just a question about, I'm reading this verbatim, but which bank has the largest exposure to the property market? And is if the worst case scenario does occur in with the real estate market, the Australian real estate market, what is the likely scenario for that bank? So it might feed slightly back into question number one there, but I was thinking about flicking this over to Leith. Leith does a lot of work looking into the balance sheets of banks.
Yeah, as far as I know, it's Commonwealth Bank number one, Westpac number two. So, Commonwealth's the largest.
Okay.
It is worth noting, though, as well. So, yeah, absolutely right. Westpac and ANZ and NAB have got a lot more business exposure.
Sure.
Having said that, the question is, if you're talking about biggest as a percentage of their loans, what you might find is some of the smaller Bank of Queensland's and certainly some of the regional credit unions and all that type of stuff will be much more highly exposed because they just don't have the business lending.
Absolutely. Okay.
So, yeah, it depends on the smaller ones are going to be the most at risk. And,
Okay.
But then of the big four, it's CBA, Westpac.
Okay, very good. All right, excellent. No worries. Thanks for that, Damien and Leith. So we'll jump back onto the script now. So we've got our next look into the fundamental side was having a look at the Australian banks vis-a-vis the rest of the world.
Yeah. So look, versus the rest of the world. So we spoke about Australian banks being cheap. Globally, banks are relatively cheap versus the rest of the world. So Australian banks don't look anything special compared to the rest of the world. We earn higher. We're earning some higher return rates on return on equity.
Okay.
But then again, we've got a lot of these banks are sitting in zero interest rate environments and very sluggish economies and quantitative easing and increased regulation following the financial crisis, and a lot of these banks were bailed out and still have government holdings are still tipping out. So Australia's banks are earning some of the highest returns, average to a little bit average to a little bit high in terms of valuations. And so the question is, if earnings are a cyclical peak in Australia or higher than elsewhere, then do they deserve to have an average valuation, or should it be a little bit lower?
Okay, sure.
The next chart is one which I've just tossed up, which is just looking at the Tier 1 ratio, which is it's a measure of gearing for banks, a sort of specialist bank.
And you might do you mind just running us through the X and Y's on that one? It's just a little bit cluttered.
So that's on the X-axis, and then on the Y-axis is the deposits versus loans.
Yep.
So you don't want to be in the top left-hand corner. So you basically don't want to have a high amount of loans to deposits.
Sure.
And not very much Tier 1 capital. And lo and behold, we've got sort of that's where we're sitting at the moment.
Poking our heads out the top of the the top of the bell curve there.
So I guess if you sort of go through the bits about saying broadly, if you look at the Australian banks versus the rest of the world, you don't see at the overall levels, you don't see a lot of differences. Then you start going, well, are we at a cyclical high versus some other countries, and where do we sit in terms of capital and things like that? And you can say, well, if it might be fine as long as we stay at a cyclical high, but if things roll over, then you've got more of an issue.
Okay, sure thing.
The other one I wanted to just throw out, now this is a US chart. I've just got one which basically showing this is a high yield debt. So it's not directly related to Australian banks, but it's just showing where we are in the sort of corporate cycle. So I've spoken a lot about households. Corporates is where banks tend to lose a lot of money, traditionally. The last financial crisis was obviously house driven, so that was a sort of a little bit more special.
Okay.
But the last few recessions we've had in terms of the 1990s and 2000 sort of blow ups, a lot of it was based around the corporate debt market.
Sure. Yep.
Now, what we're showing on that chart is just corporate lending debt as a percentage of GDP, and that's sort of hitting some record highs in terms of the US. Interest rates are much lower, so it's much more maintainable, but it's just showing that the default rates kick up eventually. The default rates are lagged. So basically, you get a huge increase in debt, and then default rates kick up, and then the debt falls away, whether it's written down or stopped lending or lost or whatever, and then you start the whole cycle again. And so at the moment, we're at the cycle where debt's high, but the default rates haven't kicked up. So at some stage, that cycle will turn, and it's another domino that's sort of sitting out there that could knock a few others over. And
a slight departure from the Aussie bank theme, but I know I've been reading a bit in the US about the auto loans. So we won't spend too long on this one.
No,
but
that's right. Look, it is very analogous to what happened in the financial crisis in terms of similar types of liar loans and giving and predatory lending and all these types of things like this. I think that area of the market though is not as much of an issue in that it's not as central to the whole economy. So yes, it's bad, but the fact that somebody gave a loan to somebody for a $10,000 car that they should never have got is different, and it's a depreciating asset anyway. The people who are lending that are going, well, I'm lending you a $10,000 car, but I know it's going to be worth nothing. It's going to cost me more to get it back, to go through the court system and all that, than what I would be able to sell a car for at the end.
Yep.
Whereas the lending to houses was done on the basis of, here's a $200,000 mortgage you can't afford, and but I'm hoping there'll be something. If something goes wrong, I'll be able to sell a house and get some back.
Orders of magnitude larger in the housing side.
So it's a little bit of an issue, but I'm not as concerned as I am for the housing market.
Okay, sure thing. And then our final chart for the day. So we're looking at the GFC not being a great comparison in Australia.
No. So what have popped up there is the non-performing loans to total loans. For this is just a range of some of the biggest banks in the world, and I've just split them up between Canadian banks, Australian banks, European banks, and US banks. I guess a lot of people look back and go, well, we went through this massive financial crisis, and the banks sailed through all right. And if I look back and I apply those numbers to the Australian banks at the moment, then they're still a good investment. You could lose 20-30% of, and you're still picking them up at a decent price, and eventually earnings recover, and you sort of carry this through.
Sure. What
I wanted to highlight is the Australian experience was very different to what we saw elsewhere. The big spend from China and the cash splash and a whole bunch of things meant that we came through the recession much better than anywhere else, and that you'd probably have to say, well, if you're going through a typical type of downturn, things would be 3 times worse probably than what we saw during the financial crisis. So you'd probably wipe out most of the bank's earnings for at least for a year, and then the worst cases, then you need capital and all that
systemic
stuff like
failure, sort of end of the.
Yeah, so I guess what I'm saying is, yes, you should look at risk scenarios, but you don't just classify yourself to. And the other one, the 2000 downturn as well, was also Australia managed to sail through that as well. A lot of that was sort of tech based, and so so don't treat those two downturns as being saying, well, those ones non-performing loans sort of hit 1.5% to 2%. Let me assume that happens, because you can see from those charts that a number of banks in the US were well over 4%. European banks were way up there as well, and Canadian banks, which actually did sail through not too bad, but they'll peak out at sort of 3 or 4% in both the last couple of crises. So treating a 1.5% non-performing loans to total loans, you probably should be at least doubling that, and possibly tripling it in a decent sized downturn.
Okay, sure thing. And just finally, wrapping up, obviously, as always, we like to overlay this in what we do in every day at Nucleus Wealth in our portfolios. And I guess we might as well start by giving some balance in terms of presenting a pro and an against case for Aussie banks in Australia. Damien?
Yeah, so I think the pro case is very much that they're very cheap. These things are money-making machines. There's so many Australians invested in this. There's so many Australians invested in the housing market. The government is all in on keeping everything going as long as they possibly can. Both sides of Parliament want the housing market to stay high because there's so many votes in it. They would like to bash the banks as much as they can, but they don't want to send any bank under. So the thought is, if you can get through this with a house market that goes sideways for a long time, or trends downward a little bit, but nothing shocking, then the banks are, you can pick them up, treat them as a utility, and banked by a utility which is backed by the government, and you could pick up somewhere between a 5 and a 10% return per annum on the banks, just based on the back of a dividend yield, and that might be going not growing, but it's in a low return world that looks pretty good. It does.
Okay, and for the against?
Yeah, the key one is so there's going to be some weak earnings. That's probably the banks, given the payout ratios, they can probably handle still paying out high dividends, and maybe they might have to drop them off a little bit, but there's probably not heaps in that. The key one is a tail risk, and the question really comes down to the Australian housing market. Mm-hmm. If it's hit a number of blows recently, and we spoke through the the range of things you had, where it's been hit by foreign investors pulling back. It's been hit by increased lending standards last year and more increased lending standards this year. It's been hit by higher funding costs. There's macroprudential. You just sort of keep going one by one. If it rolls over at a certain stage, and there is certainly, I fully admit, there is an ingrained psyche into the Australian investor that housing will go up, and that's what you need to do. You need to stick your money in housing because it always goes up. If that changes, then it's look out for the banks. So they've got this, and that risk has increased over the last, certainly over the Royal Commission, in that the number of things that's now going to be needed to be done, both politically and within banks themselves, to try and head off some of these issues, says to me the tail risks have increased, and those tail risks are what you need to be worried about, because that's when you see a big step down in the banks, and you need to worry about, as a question, as our caller, was worried about whether the banks go under and you get bailed in and all that type of stuff. Well, if you're worrying about that, then don't worry about the equity.
Yeah, that's right.
You got a 10% yield for a year, but if you're losing
30% or something on the share price.
Well, if you get to the stage where depositors are getting banked in, you're losing 100% on your share price.
Yeah.
But so you do need to keep those in mind, that there's a tail risk, which is not a base case, but that tail risk is certainly growing, and that's a significant downside to the Aussie banks. We've got the thing up there about a widowmaker. Internationally, Australian banks are very much looked upon as, when's this going to happen? When's the world going to wake up and these things get smashed for being overgeared, and the economy all based on one thing and all that type of stuff. And anyone taking a short position in it has lost their money because they've got this massive carry of having to pay the yield. And so it's called the widowmaker, because people keep going short Australian banks and loses out. But if you get a decent housing downturn, they will certainly be back with a vengeance. And there's plenty of international people who probably aren't short at the moment, but they're champing at the bit, waiting for a good opportunity and a good excuse to go short.
Okay, wonderful. Very good. Okay, well, look, that is a wrap on the content of our webinar today on the Australian banks. I'm sure you'll agree with me. It was illuminating and also probably a little bit upsetting in regards to the future of a very major component of the Australian economy. Thanks, gentlemen. Thanks, David, Damien and Leith for coming in and sharing with us your thoughts on what is a central investment, component for most people. If not in your own pocket, then almost certainly in your superannuation. So if you'd like to get some more information on what we do every day at Nucleus Wealth and how potentially you could mitigate some of the issues that we've brought up today in your investment portfolios, check out the following bit of information.
Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment. To ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com.
Okay, so if you've enjoyed today's webinar, then I'm almost certain that you'll get a kick out of next week. So same bat time, same bat channel on Thursday, the 3rd of May at 12:30. We will be covering housing, Australia's favourite bubble. Quite interrelated, I think you'd agree, in today's topic, and it will make for some enthralling viewing. Of course, it's been a major theme of the Macro Business blog, and there's going to be some terrific graphs and content in that one. So if you're looking forward to that, jump over to proton.nucleuswealth.com to register your interest, and therefore we can keep you in the loop and send you some reminders for that one as well. As always, we will be sending out our feedback questionnaire link. Maddie will be our head of communications, will be looking after that. It gives you a chance to give us some feedback on our performance today and how we've gone. But also, if you'd like, jot in some topics that you'd like to hear about in the future. We can go away, do some research and bring them to you. So on that note, I hope you've enjoyed today. I certainly have. And we look forward to catching you at the next one. Cheers.